Warm welcome to CA Raja classes and thank you so much for joining this mini and micro webinar. Before we get into the discussion, let me just take a couple of minutes to introduce myself. I am CA N Raja, a chartered accountant by qualification, a teacher and trainer by passion, and teacher for 3 lakh plus students worldwide. I started my career as a banker with State Bank of India. Then after a period of 4 years, I got into CA practice. I had my practice for 7.5 years. But I realized my calling is teaching. I started focusing on teaching and training, and today, with the blessings of God, we have 3 lakh plus students worldwide. So now it's time for us to get into the session. In this session, I'll take you through the difference between DSCR and FOIR. First, let's look at the meaning. What do we mean by DSCR? When we say DSCR, it stands for Debt Service Coverage Ratio. Here, banks and financial institutions are basically going to measure the repayment capacity of the borrower for the term loan they have availed for a project. So what is the focus? The focus is measuring repayment capacity of the borrower. Then what is FOIR? FOIR stands for Fixed Obligation Income Ratio. And here also bank is going to measure the repayment capacity, but here it is measuring the repayment capacity of the borrower with reference to it can be a business loan, a mortgage loan, or a long-term loan. But both the ratios, they basically measure repayment capacity. Okay, what is the formula that is used in these ratios? First, let's look at DSCR. DSCR ratio, the formula, numerator is cash accruals and denominator is obligation. How this cash accruals is calculated? It is calculated as profit after tax. Then it is added back by depreciation because it is a non-cash item. Then it is added back by interest on term loan because we want to know what is the cash profit before paying interest. So for that reason, we add back interest on term loan. This goes to the numerator. Whereas in the denominator, it will be interest on term loan plus principal commitment. So this will be calculated for each and every year so that DSCR of each and every year can be understood and arrived at. Whereas FOIR, the formula is like this. It is fixed obligation divided by income. And when I say fixed obligation, it is the fixed obligation with regard to the present loans which are running and the future loans that is proposed. Okay, so this fixed obligation is basically the summation of EMI, which includes interest and principal. So you should factor both the present running outstanding loans commitments as well as the proposed loan commitments. That goes to the numerator. Whereas in the denominator, it is income. When we say income, this is cash profit. And this is one distinct difference when compared with DSCR. Here, when we take the income in FOIR, that is the cash profit, it is freezed as per last financial information. That is, if the customer is approaching now, let's say we are in December 20, the customer is approaching loan now for let's say next 5 years. For next 5 years, what will be his cash profit? That will be based on his last submitted financials. In next 5 years, he may earn more. He may have more cash profit, but that will not be taken into consideration. Okay, so that's the distinct point when it comes to FOIR, because in DSCR, what you are going to do is you are going to arrive at cash profit for future, and in future this cash profit can be estimated to increase. That's what I have in next point. Look at here how cash source is measured. If you take DSCR, it factors estimated projected cash flows which can be based on future cash profits, and this future cash profit can be estimated to increase. Let's say for example, a customer approaching a bank for a term loan to start a business. It means this business will acquire assets. Using that asset, they will produce product, then they will make sale, then out of that they will make profit, and using that profit they will service the loan. Okay, in those cases DSCR will work out. Even for existing businesses which are going for expansion, it's possible that their cash profit can increase from their present level. In those cases also DSCR will work out. But wherever this FOIR ratio is used, it is always based on cash profit as at last year. It will be pegged at that level. Let's say, for example, the cash profit of the last year is 1 crore and they have come for a term loan, let's say repayable over a period of 5 years. A term loan, let's say like a mortgage loan. Now, for the next 5 years, their annual cash profit will be freezed at 1 crore. So with that 1 crore, whether they will be able to service the loan or not, that's what getting measured. Whereas in DSCR, it is possible that this 1 crore can increase because of change in sale, because of change in capacity, because of change in fixed assets. So that element will be accepted in DSCR, but not in FOIR. Okay. So this is how cash source is measured. Then what are the obligations that are considered? Because in both the ratios, what we are doing, we are comparing the income and obligation. Okay, what obligation? I think here both DSCR and FOIR does the same job. DSCR factors running past loan obligations as well as the proposed loan obligation. FOIR also factors running past loan as well as the proposed loan obligations. Okay. When DSCR is suitable, when FOIR is suitable. DSCR is suitable for project financing, let's say like term loan, because this is going to involve estimation, projection. It's possible future revenue can be estimated, projected to increase, same the profits and cash profits. Whereas FOIR can be used for medium to long term loans where the repayment is based on existing cash profit, existing capacity. That's why generally we see this in mortgage loan, business loans and all, right? And what is the minimum acceptable level? If you take DSCR, the minimum acceptable DSCR for each and every year throughout the loan tenor will be like 1.5 times every year. Of course, it could vary bank to bank depending upon the bank's risk perception. Conservative bank will say something like 1.5 times, whereas the banks which are ready to take a little bit of risk, they'll go even up to 1 time. Okay, this is every year. That is, if the loan is for 5 years, for each and every year, the ratio should be at least 1.5. And average DSCR will also be calculated, which should be at least 1.75. And again, it can vary bank to bank. That's about DSCR. Whereas FOIR, it is calculated in a kind of a reverse model because we are comparing the fixed obligation with the income. Okay, so fixed obligation is seen as a proportion of income. So it should be between 40 to 55%. So if fixed obligations are greater than 55%, it means they are leveraged. They may not become eligible for financing. But on the other side, if FOIR is below, much below, say somewhere like below 40%, it indicates they have much of repayment capacity. Okay, so these are the broader differences. Even other differences can be added, but these are all the differences which I wish to add. Thank you for watching this webinar. I am sure you have derived value from this webinar. And if you wish to learn more, I have some good opportunity for you. What is that? Check out.
It is this Credit and Financial Analysis Mastery course exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over. You also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 + 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 + 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. And not yet over, you're also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.